So the end of the year is approaching, and you have some money lying in your bank account. You know that it loses value over time if uninvested, and you're wondering what you can quickly do about it so you can feel good about yourself. Let's leave aside everything that happens in the world right now and consider it from a different point of view. So, is it better to invest your money at the very end of the year, in December, or wait and invest it as soon as the new year starts, sometime in January? Well, there's a couple of points to consider. Let's start with December. So, what makes this month an attractive time to invest? The first advantage of investing in December is potential tax benefits. Toward the end of the year, some investors adjust their portfolios to optimize tax deductions. For example, they might sell certain assets to balance their taxable gains from other investments, which can help reduce their taxable income. For new investors, this activity can create opportunities to buy stocks at slightly lower prices, as others are selling for tax-related reasons. However, tax regulations vary by country, so be sure to check how these strategies apply in your region. December is also known for what's called the Yender Rally or Santa Claus Rally. This is when markets tend to rise in the final weeks of the year. Some say this is because of increased holiday spending or optimism around the new year. While it's not guaranteed, historically, there's often a slight upward trend in December, which could benefit those who invest at the end of the year. Finally, December can bring some volatility, especially because large institutions are rebalancing their portfolios. This means they're buying or selling assets to meet their year-end targets, which can cause quick price swings. For investors who know how to handle this volatility, there may be opportunities to buy assets that dip temporarily. Of course, December also has its downsides. While the year-end rally is exciting, it's not all good news. If stocks are trending upward, this can also mean higher prices, which may lead to a more expensive entry point for new investors. So, if you're buying in December, keep in mind that prices might be a bit inflated, especially for popular stocks. And then there are the holiday closures. Markets have shorter trading hours and more closures around this time, which can limit opportunities to trade. Additionally, with fewer people trading during the holidays, liquidity can be lower, meaning there might be fewer buyers and sellers, which could lead to higher spreads or less price stability. So now let's look at January. What are the pros and cons of waiting until the start of the new year to invest? First up is the well-known January effect. This is a phenomenon where stocks, especially smaller ones, tend to see a bump in prices during January. Many believe this happens because people are reinvesting year-end bonuses or setting new financial goals. Data from the last 30 years shows varying levels of the effect. In some years, January performed well, but in others, it didn't stand out compared to other months. So while it's not guaranteed, the January effect can make it quite an exciting time for those starting fresh in the new year. In January, there is often fresh optimism and capital flowing into the market. Investors are setting new goals and many funds get fresh cash to allocate. This means more activity, which can create momentum for those investing at the start of the year, especially as institutional investors and funds may be looking to rebalance their portfolios. After the Yender rally, some stocks can experience a bit of a pullback, which might create an opportunity to buy at a discount in January. If the rally pushed prices up in December, January could give investors a second chance at a more attractive price. But, like December, investing in January has a few downsides too. So if you hold off until January, you might miss out on gains from the December rally. Waiting until after the rally means you might miss those final weeks of potential growth. This is something to consider if you want exposure to all end-of-year market trends. Lastly, there can be a lot of demand in January, especially as people set New Year goals or reinvest their bonuses. This higher demand might drive prices up, and make certain assets more competitive to buy, potentially leading to slightly higher costs if many investors are interested in the same stocks. So, should you invest in December or January? It really depends on your personal strategy. December may offer tax advantages, access to the yen-dollar rally, and some buying opportunities from volatility. But it also has some potential price inflation and lower liquidity during the holidays. January, on the other hand, could offer a fresh start with new cash flows, that January effect, and a chance to buy after a December rally. However, you might face more competition and miss out on December's rally. Ultimately, there is no one-size-fits-all answer. Think about your goals and risk tolerance and choose the timing that fits your plan best. Thanks for watching and let me know in the comments. Do you prefer investing at the end of the year or the start of the new one?